Banks will no longer be allowed to own, invest, or sponsor hedge funds, private equity funds, or proprietary trading operations for their own profit, unrelated to serving their customers.
The Volcker rule is that banks shouldn't be using money that's backed by American taxpayers to gamble on the markets. This affects what's called proprietary trading, and that's something that Goldman Sachs and a lot of these big banks have made a huge amount of money on in the last year because the Fed has made money free, and so these guys are taking the free Fed money and betting on the recovery of the markets with it. That is why they've had such huge profits and why we've had huge banker bonuses. And so what the Volcker rule would do would be to make it harder for banks to bet on these big risks.
But these firms should not be allowed to run these hedge funds and private equities funds while running a bank backed by the American people.
Even more than the proposal itself, I think that's why we saw a big sell-off in Goldman Sachs and JP Morgan in these banks, is not that the rule that they propose would necessarily really hurt their business. It's that Volcker has been yelling for years about how we've let the banks get too big and we've given them too much room. And so if you take what Volcker's been saying to the logical extreme, you actually would eventually get a proposal where you're going to break up Goldman Sachs and JP Morgan. They're much bigger than they were 10 years ago, all these banks. The concentration of the banking industry is much greater than it's ever been before. It seems hard to argue that we don't need any regulation after the whole thing blew up 2 years ago. I mean, I think one of the things people are skeptical of the ability of regulators to keep up with what banks are doing. I mean, people are getting paid a lot of money to come up with new ideas, so the regulators are never going to be able to keep up with that. That's why one of the things that people will say is a good idea, something like the Volcker approach, something structural where you're taxing the banks for being too big, or you're preventing the banks from doing what you view as conflicting things. So if you put those kinds of rules in a sense, all the regulators have to do is enforce a pretty bright line, which is much easier than getting them to try to, as we've seen, the regulators are not all that good at doing things like making judgments as to when we have housing bubbles and when banks are taking on too much risk. I mean, they don't do that well.
For while the financial system is far stronger today than it was 1 year ago, it's still operating under the same rules that led to its near collapse.
I think everyone would agree that even people who want to reform the banks would say this is not the end all. You need to go further and do other things, whether it's cleaning up derivatives or doing things to make it hard for banks to exist at these giant sizes, taxing them or something like that, because there's a perception certainly that having banks of this size it creates these monstrous potential problems that there's no way around.